Look at your crypto portfolio. If it's a list of coins named after internet jokes, dogs, or community tokens, I have a confession to make. You aren't an investor. You are a donation. You are the exit liquidity for the 1%. You are the fuel that pays for some 24-year-old developer's third villa in Bali, while you're refreshing Twitter, waiting for a billionaire to post a cryptic emoji. The actual 1% are looking at this market as a 99% cesspool of scams and a 1% asymmetric opportunity to own the next iteration of the global financial stack. The 1% aren't buying lotto tickets. They're building the picks and shovels. Today, I'm giving you the shadow blueprint, the 3-filter system the elite used to separate the digital garbage from the infrastructure that will run the global economy for the next 50 years. By the end of this masterclass, you will stop being a follower and start being an architect. Welcome back to Wealth Architect. I'm Ben. Most people enter crypto with an employee mindset, looking for a get-rich-quick shortcut. That is a psychological glitch I call the dopamine debt trap. Your brain is evolutionarily wired to hunt for patterns and seek high-reward wins. In the prehistoric world, that kept you alive. In the crypto world, it makes you a victim. Scammers hack your amygdala by creating belief-based assets. They use words like army, tribe, and hodl to create a sense of belonging. Why? Because as long as you feel like part of a tribe, you won't look at the balance sheet. You'll keep holding while they keep selling. The financial rules most people follow were designed to create employees, not owners. Saving 10% and waiting 40 years is a retirement lottery ticket. Chasing meme coins is just a high volatility version of that same dependency. Today, we kill the follower. We move from belief to architecture. We stop buying digital prayers and start building economic moats. The first filter is brutal. Does the project generate revenue? If a project's price only goes up because people are talking about it, that is a Ponzi scheme by definition. The 1% look for an on-chain income statement. The DEX example. Look at a decentralized exchange like Uniswap. They charge a fee for every single trade. That is real revenue. The lending example. Look at AV. They collect interest from borrowers. That is a banking business. The architects move. If a project does not have a mechanism to capture value from actual users, not just investors, looking for a pump, it is a belief system. In a recession, beliefs are the first thing to be abandoned. Revenue-generating protocols have a floor. Belief systems have a trapdoor. In 1849, the miners went broke. The people who got rich sold them the picks, the shovels, and the denim jeans. In the digital gold rush, the 1% are the infrastructure architects. You don't bet on which coin will win. You bet on the utilities every coin needs to exist. Layer 2 scaling. These are the digital toll roads. Every time someone buys an NFT or swaps a token, they pay a toll to the highway. Owning the L2 is like owning the Interstate 95. Oracles. Blockchains are blind. They don't know the price of oil or who won the Super Bowl. Oracles are the data pipes that feed real-world info to the chain. Without them, the entire DeFi ecosystem collapses. InterOperability. Bridges. These are the digital shipping lanes that allow different blockchains to talk to each other. These aren't coins. They are utilities. You aren't betting on a dog to go to the moon. You are betting on the internet to continue existing. That is an asymmetric bet with a massive margin of safety. The final filter is institutional validation. Before you put a single dollar into a project, you must look at the early architects. Is the project backed by anonymous developers and influencers with laser eyes? Or is it backed by a 16Z, Paradigm, or Sequoia? These firms spend millions of dollars on technical, legal, and economic due diligence that you simply cannot do. When they invest $50 million into an early-stage infrastructure project, they aren't gambling. They are taking a calculated position based on a technical blueprint. Following the smart money isn't just a trend, it's leveraging millions of dollars of outsourced research. If the 1% aren't in the project, you shouldn't be either. Now, how do you build this? An architect doesn't go all in. The core, 70%. Revenue-generating infrastructure, the picks and shovels. The growth, 20%. Emerging Layer 2 South and oracles with VC backing. The speculation, 10%. High-risk bets on new technology. This structure protects your capital from inflation and bad decisions while giving you exposure to the massive upside of the digital shift. You are building a cash flow engine, not a lottery ticket. Stop gambling on lotto tickets and start architecting a portfolio of picks and shovels. Use these 3 filters: revenue, infrastructure, and institutional backing to cut through the 99% cesspool. The system isn't broken. It's working exactly as intended, just not for you. It's time to change that. I've deconstructed the blueprints. Now you have to build. Subscribe to Wealth Architect, join our community of owners, and let's start designing your freedom. Your future self will thank you. Hit the bell. I'll see you in the next blueprint.